Look, I want everyone to just pause for a second and actually look at the data coming in from this weekend. Because what we just witnessed, this liquidation event, it honestly defies pretty much every standard correlation model you'll see in any textbook. This wasn't just some gentle portfolio rebalancing, and it definitely wasn't just retail traders messing around with leverage on a Saturday night. This looked like a strategic, really violent dislocation of capital. And it happened, crucially, while the legacy markets were asleep. If you look at the last 48 hours, we basically saw two massive signals flash red, and they happened simultaneously. First, you had this massive tranche of physical silver. It was just removed from the authorized vaults. It was a frantic drain. We were talking about millions of ounces moving from the eligible category to registered, and then poof, out the door, gone, disappeared, wherever into private storage. And second, literally at that exact same moment, Bitcoin spiked vertically. It broke through critical resistance levels on volume that, honestly, we didn't see in a lot of time. So let me repeat that so the gravity of this actually sinks in. You have physical silver being drained from vaults at a record pace. And at the same time, the premier digital hard asset is skyrocketing while the banks are closed. That's not a coincidence. That is a flight to safety. That is smart money exiting the fiat system through really the only two exits that are actually open on a weekend: crypto and private physical settlement. Now, obviously, I'm never going to ask for your money. I'm not here to pitch some get-rich-quick scheme or sell signals. Just protect your capital, do your own homework, and please stay far away from those scams, people who are using my name in comments. But here's why this specific combination, silver draining and Bitcoin spiking, matters more than, say, a Fed meeting or a CPI print. Usually they tell you these assets are uncorrelated, right? They say silver is just an industrial metal and Bitcoin is this risk-on tech play. But that narrative is designed to keep people confused. The reality, the mathematical reality, is that both of these assets are barometers for the health of fiat currency system as a whole. When the dollar system is stable, sure, they do their own thing. But when the system cracks, when the plumbing gets clogged, they move together. They become the ringing alarm bells. And this weekend, the alarms didn't just ring, they screamed. Let's just connect the dots on the silver side first. We've been tracking the COMEX inventory levels for months now. We know the registered stocks, that's the metal actually available for delivery, have been hovering at dangerously low levels. We know the bullion banks have been playing this shell game, moving metal back and forth between London and New York to create the illusion of liquidity. But what happened this weekend, that was different. Reports from private vault operators and wholesale distributors indicate a sudden massive demand for immediate physical possession. Not paper contracts, not allocated accounts. We're talking physical bars on pallets, stuffed into crazy armored trucks. Why? Why the urgency? Why they pay the weekend premium? Because clearly someone knows something. Someone with deep pockets and serious connections decided that they literally could not wait until Monday morning. They decided that the risk of leaving their capital in the banking system for another 48 hours was just too high. They decided that paying a premium for immediate delivery was actually cheaper than the risk of systematic freeze. And while that physical metal was moving in the dark, Bitcoin was moving in the light. Because Bitcoin trades 24/7, it is the only real-time gauge of global liquidity preference we actually have. So when you see Bitcoin rip higher on a Sunday while the bond market is closed, it tells you that capital is fleeing a jurisdiction or a currency, and it's looking for a neutral reserve asset. So put it together, physical silver is being seized. Digital hard money is being bid up. This is a classic liquidity bypass. The big players are bypassing the dollar. They are bypassing the SWIFT system. They're bypassing the counterparty risk of the commercial banks. I mean, let me ask you a simple question. If the economy is strong, if the banks are solvent, if inflation is really under control, why is smart money panic buying insurance assets on a weekend? The answer is because the structural deficits we talk about, the debt, the unfunded liabilities, the geopolitical fragmentation, they are starting to matter right now, not in 10 years. Now. So, here is the technical picture for Monday morning. The paper markets in New York and London, they are going to open into a vacuum. The algorithmic trading systems that run the futures markets, they are programmed to fade volatility. They are programmed to sell spikes and buy dips to keep prices within a statistical range. But algorithms cannot print physical silver. They cannot conjure metal out of thin air. If the drain we saw this weekend continues into the open, if the industrial users and the sovereign buyers step in and say, we want delivery, the shorts are trapped. The bullion banks, who are historically net short silver to hedge their books or manage the price, they will be staring at a delivery failure. That is a default. That is force majeure. That is the moment the paper price and the physical price divorce completely. Now, let me give you the bearish case, because I'm not here to sell you a fantasy. I'm here to prepare you for the reality. The empire will strike back. The first risk for Monday is the fake out. We have seen this before. They let the price run up in the illiquid overnight session to suck in the retail longs, the FOMO buyers who chase green candles. Then, right at the New York Open, 8:30 a.m. Eastern, they dump a massive amount of paper contracts, notional silver that doesn't exist, to smash the price back down. They trigger the stop losses. They flush out the leverage. They paint the chart to look like a reversal, to scare you out of your position. The second risk is the dollar index, the DXY. If there is a broader liquidity crunch, like if a bank is failing in Europe or Japan, capital might rush into the US dollar simply because it is the cleanest shirt in the dirty laundry basket. If the DXY spikes, the algorithms will automatically sell silver and Bitcoin, regardless of the fundamentals. It is a knee-jerk reaction. It is a correlation trade. The third risk is margin calls. If this weekend volatility was caused by a fund blowing up, they might have to sell their winners to pay for their losers. They might have to liquidate their gold and silver positions to cover margin on their tech stocks or their bond portfolios. In a liquidity crisis, you don't sell what you want to sell. You sell what you can sell. But here's the mid-video reframe that changes everything. Even if they smash the paper price on Monday, even if they print 1 billion paper ounces to cap the rally, even if the DXY goes to 110, it does not put the physical metal back in the vault. The metal that left this weekend, it's gone. It is in strong hands. It is not coming back to the market at 30 or 35s or even $50. It has moved into strategic reserves. Every time they smash the paper price, they make the physical metal cheaper for the entities that are draining the COMEX. They are subsidizing their own demise. They are holding the door open for China, for India, for the BRICS nations, for the industrial users to back up the truck and load up on real assets at a discount. This is the trap. The lower they push the price, the faster the physical inventory disappears. The higher they let the price go, the more their short positions blow up. They are caught between a physical shortage and a paper derivative implosion. And Bitcoin spiking, that's the confirmation. It confirms that this is not just a commodity supply issue, it is a monetary trust issue. People are losing faith in the settlement layer of the fiat system. So, what happens? Monday? Expect volatility, expect violence, expect the media to ignore the silver drain and focus on Bitcoin volatility or some distraction in the political sphere. They won't tell you that the warehouses are empty. They won't tell you that the premiums on physical coins are decoupling from the spot price. You have to look at the spread. Watch the difference between the spot price and the near-month futures contract. Watch for backwardation. If silver trades higher for immediate delivery than for delivery next month, the game is over. That is the market screaming that there is no metal. Watch the volume. If the price smashes down but the volume is low, it's a trap. If the price rips higher on massive volume, it's a breakout. But most importantly, watch your own emotions. Do not trade this with leverage. Do not gamble with money you cannot afford to lose. This isn't a casino. This is a crime scene. And you're witnessing the evidence being removed in real time. The system relies on you staying asleep. It relies on you thinking that paper claims are the same as physical assets. It relies on you trusting the counterparty. But this weekend, it proved that the big money does not trust the counterparty anymore. They took their chips off the table. They took their metal out of the vault. If they are exiting, why are you still acting like everything is normal? Monday is going to be a battleground. The shorts will defend their positions with everything they have. They have the printing press. They have the media. They have the regulatory agencies. But we have the math. We have the physics. We have the undeniable fact that you cannot consume what does not exist. The deficit is real. The drain is real. The flight to safety is real. So, verify what I've told you. Check the delivery reports. Check the Bitcoin volume. Check the premiums at your local dealer. Do not let them shake you out of your position with a paper price smash. Do not let them scare you with volatility. Volatility is just the price you pay for being right before the rest of the world catches on. This is the separation. This is where the paper holders get wiped out and the physical holders get proven right. Stay liquid. Stay skeptical. Stay disciplined. Invest with logic, not hype. OG out and about. Here,